How do you convince the world's smartest investors that renting desks is a technology revolution? For a few years, one company had the answer. It built a $47 billion empire on glass walls, free coffee, and a story about changing the world. And then, it all fell apart after a single regulatory document hit the internet. This is the rise, the unraveling, and the hard landing of WeWork. The story of a tech unicorn that was really a landlord in a hoodie, and the document that broke the spell. January 2019. In the exclusive world of private capital, one number is on everyone's lips: $47 billion. After another huge check from Japan's SoftBank, WeWork, now rebranded as the We Company, achieves a valuation that dwarfs almost every publicly traded landlord on the planet. This isn't just a company, it's a phenomenon. It's the biggest office tenant in New York City and London. Its charismatic founder, Adam Neumann, is hailed as a visionary, a disruptor on par with the tech titans. The story felt permanent because it was everywhere. New locations bloomed across the globe seemingly overnight. Media coverage was breathless. This wasn't just office space, it was the future of work itself. WeWork wasn't in the real estate business, the pitch went. It was in the space-as-a-service business. It was a platform, a community, a network. The language was deliberately borrowed from software, and for a world desperate for the next big tech play, it was an irresistible narrative. So what was the actual product? On the surface, it was simple. WeWork signed long-term leases for entire floors of office buildings, often for 10 or 15 years. Then, they would spend a fortune building it out with their signature aesthetic: glass conference rooms, exposed ductwork, communal tables, and beer on tap. They chopped up that space and sold flexible, short-term memberships to freelancers, startups, and, increasingly, large corporations who wanted a hipper, more flexible footprint. The value, they claimed, was in the spread between the long-term cost they paid and the short-term revenue they collected. But the real sales pitch went beyond the balance sheet. It was about culture. Neumann sold an idea of work that was more than a job. It was a lifestyle. This was reinforced by a near-mythical internal culture. There were the legendary summer camp festivals, corporate retreats that resembled music festivals, complete with big-name artists and an endless flow of alcohol. All-hands meetings were more like rock concerts, fueled by tequila shots. The mission wasn't to rent desks. It was, according to company filings, to elevate the world's consciousness. This wasn't just a business plan, it was a movement. This global blitz was powered by one main source: SoftBank's Vision Fund, led by Masayoshi Son. After a brief meeting with Neumann, Son was famously captivated, deciding to invest billions. He reportedly told Neumann that in a fight, the crazy guy wins, and that WeWork wasn't being crazy enough. The message was clear: grow bigger, faster, at any cost. This wasn't just capital, it was an instruction. Forget profits, forget unit economics. The goal was to achieve such scale and brand dominance that no competitor could ever catch up. Momentum itself was the business model. But while the party raged, a different story was being written in the accounting ledgers. The numbers, when they were finally revealed, were staggering. In 2018, the company generated impressive revenue of about $1.8 billion. The problem? It posted a net loss of roughly $1.9 billion. It was spending more than $1 to make every dollar. For the first half of 2019, the story was the same: $1.5 billion in revenue against a net loss of $900 million. This wasn't the temporary, manageable burn of a software startup. This was a colossal bonfire of cash.
The fundamental flaw was baked into the model. WeWork had locked itself into decades of fixed costs. Its future lease obligations, the rent it was legally required to pay, totaled a breathtaking $47 billion. These were ironclad 15-year contracts with powerful commercial landlords. Yet, its revenue came from customers on flexible, often month-to-month contracts. In a good economy, it worked. But if a downturn hit, WeWork's members could vanish, while its multi-billion-dollar rent bill would keep coming every single month. It was a massive, leveraged bet on permanent economic sunshine. History offered a clear warning. A similar company called Regus, now known as IWG, had tried a similar model, overexpanded during the dot-com boom, and was forced into bankruptcy protection in 2003 when the market turned. WeWork's innovation wasn't the business model. It was branding that model as technology and getting investors to believe it. The committed revenue backlog at the time was only in the low single-digit billions, a drop in the ocean compared to its $47 billion liability. As the IPO approached, another set of cracks appeared, this time around governance. Adam Neumann ruled the company with near absolute authority through a special class of supervoting shares that gave him 20 votes for every one held by a normal investor. The board was packed with allies, but it was the conflicts of interest that raised the most eyebrows. Neumann personally owned buildings and leased them back to his own company. He had the company pay him $5.9 million for the trademark to the word "we," a decision so widely mocked he eventually returned the money. Most alarming for potential public investors was the revelation that Neumann had already started cashing out. He had sold stock and taken out large personal loans against his shares, extracting a reported $700 million from the company before it had even sold a single share to the public. The classic founder story is one of alignment. I only win when you, the investor, win. This was the opposite. It suggested the founder was de-risking his own finances while asking everyone else to take on the massive risk of a cash-burning operation. And then, on August 14, 2019, the spell was broken. WeWork publicly filed its Form S-1, the registration document for its IPO. For years, the company's story had been told through curated slide decks and charismatic interviews. The S-1 was different. It was a legally mandated confession booth filled with audited financials, risk factors, and footnotes. For the first time, all the pieces were in one place: the spiritual mission statements, the complex corporate structure, the founder's total control, and the horrifying, undeniable losses. The reaction from the financial world was immediate and brutal. The S-1 was passed around not as a serious investment prospectus, but as a piece of corporate absurdism. Analysts mocked its dedication to the energy of we. They counted the dozens of mentions of the word community and contrasted it with the billions in losses. They saw the $47 billion in lease obligations not as a platform, but as a gigantic liability. The S-1 arrived not as a brochure, but as an autopsy report written before the patient was officially declared dead. The investor roadshow was a disaster. The public market investors who manage pension funds and retirement accounts were not impressed by the talk of consciousness. They saw a deeply unprofitable real estate company with a governance structure that looked more like a monarchy than a public corporation. The bankers, sensing disaster, began desperately slashing the target valuation. From $47 billion, the talk dropped to 30, then 20. Reports suggested they might be lucky to get 15. WeWork tried to make last-minute changes, curbing Neumann's voting power, but it was too little, too late. The trust was gone.
By late September 2019, the situation was untenable. The IPO was officially postponed and then withdrawn. The momentum story had hit a wall, and without momentum, it was just a cost structure. On September 24th, under immense pressure from his board and investors, Adam Neumann resigned as CEO. The nine-figure IPO that was meant to be his coronation had instead led to his exile. But the company he left behind was still burning through cash at an alarming rate, and now its primary source of funding, the public markets, was gone. A rescuer had to appear, and it was the same one that had bankrolled the ascent. On October 22nd, SoftBank announced a massive rescue package. It wasn't an act of charity. It was an act of desperation to protect the nearly $10 billion it had already invested. The deal injected up to $9.5 billion more into WeWork, but at a punishing valuation of just $8 billion. The $47 billion dream had evaporated in less than a year. Control was effectively handed to SoftBank, and Neumann was paid a fortune to walk away, a reported package of over $1 billion. The party was over. Under new leadership appointed by SoftBank, the painful work of triage began. In November 2019, the company laid off 2,400 employees. The $60 million private jet was put up for sale. Side businesses like the We Grow School were shuttered. The new strategy was survival. But just as this painful restructuring began, the world delivered the ultimate stress test. The 2020 pandemic emptied offices globally, attacking the very core of WeWork's business model. The fatal flaw, long-term leases and short-term customers, was exposed in the most brutal way imaginable. Against all odds, WeWork did finally make it to the public markets in October 2021. Not with a splashy IPO, but through a quiet merger with a SPAC, a blank check company. The valuation this time? A more modest $9 billion, an 80% haircut from the peak. But going public didn't change the underlying math. The company was still losing money, still crushed by expensive leases signed in a different era. Hybrid work was the new normal, and the demand for 5-day-a-week office space that underpinned the entire business model was gone. The final act was slow, then sudden. In August 2023, the company issued a stark warning, citing substantial doubt about its ability to continue as a going concern. It was a formal admission that the clock was about to run out. On November 6, 2023, WeWork filed for Chapter 11 bankruptcy protection. The $47 billion tech myth ended where it was always destined to, in a courtroom, as a complex and very expensive real estate workout. What is the lesson from the WeWork saga? First, that a powerful story can raise billions of dollars, but the balance sheet always keeps the score. The mismatch between long-term liabilities and short-term revenue is not a disruption. It's a structural weakness that gravity will always find. Second, governance is not a footnote. Opaque structures, self-dealing, and a founder treating the corporate treasury like a personal bank account are red flags that public markets will not ignore. Trust, once broken, is nearly impossible to repair. But the biggest lesson is about an era. WeWork was a child of a decade of near-zero interest rates, where capital was cheap and investors were terrified of missing out on the next world-changing unicorn. In that environment, a good story was often more valuable than a good business. WeWork proved that when a charismatic founder is handed a blank check and told to be crazier, the result isn't always genius. Sometimes it's just a much faster, more expensive crash. One document did not kill WeWork. It simply showed what it really was. The S1 was a mirror. The market did the rest. If you like clear stories like this, with modern companies rising and then meeting the balance sheet, subscribe and stick around. There are more fortunes, frauds, and face plants on the channel. Thanks for watching, and see you in the next one.